You're watching America's Forum on Newsmax TV. I'm J.D. Hayworth.
J.D., I'm John Bachman. Thanks for sticking around and watching the show with us. Let's turn our attention now to some delicate fiscal matters. We're talking specifically about the Volcker Rule here, named for former Fed Chair Paul Volcker. It's intended to limit so-called proprietary trading by banks, cracking down on commercial institutions and investment banks that are essentially trading for their own profit. The Federal Reserve has extended the term for full compliance with the Volcker Rule to July 21st, 2015, but industry groups have complained that the rule is vague and unworkable. 5 different regulators were tasked with writing the rule, but none were given the responsibility of interpretation, examination, supervision, or enforcement of the final regulation. An interagency group was set up in February to deal with this problem, but it answers to all 5 regulatory bodies and meets behind closed doors. Sounds like bureaucracy, doesn't it? It also remains unclear how organizations are to contact the group should a question arise.
Well, this prompts a lot of questions, and because it does, we're joined by Dick Bove, the equity research analyst for Rafferty Capital Markets. Dick, we thank you so much for joining us on America's Forum.
Thank you, J.D.
Now, Dick, let's go back and take the broad view of this. Can you tell us why the Volcker Rule in the mind of Paul Volcker was necessary?
Well, I actually think if you take Paul Volcker's actual statements, he didn't propose this rule because he thought it was going to solve any problems related to financial crises. In fact, he admitted freely that if the Volcker Rule had been in effect before the financial crisis, that basically it would not have stopped the financial crisis. His problem essentially is that he really gets upset if he thinks depositors' money, which is guaranteed by the FDIC, is being used by banks to trade in the market. He finds that to be totally unacceptable. And secondly, he believes that the market, he believed, or I don't know if he believes today, he believed that the market was not operating freely if, in fact, brokerage firms could move in and buy and sell for their own accounts against their clients. So he just did not want to see that happen.
Well, Dick, in this situation, and certainly the foundation of this differs from, say, what we used to pass in Congress. We get a fair amount of criticism there, but here's what I'm talking about. You have something, let's say, that's passed by the Congress and signed into law. Then the administration or the appropriate bureaucracies must actually enforce it. And it sounds to me as if the trouble is coming from all these different agencies that have some stake in this, but no one with the ultimate responsibility to really put the implementation of the rule in place. Is that the essence of the problem right now?
Well, yes, and I think it goes beyond that, because I'm giving you Paul Volcker's point of view, not mine. My point of view is that the Volcker Rule is extraordinarily harmful. And the reason why I think it's harmful is because I think it removes liquidity from the marketplace. And if it removes liquidity from the marketplace, ultimately it forces the person who's buying or selling stock to pay slightly higher or to get slightly less. And the Volcker Rule actually goes beyond, simply preventing proprietary trading by large brokerage firms. It also limits the amount of money that can go into venture capital companies. For example, I was talking to Goldman Sachs earlier today, and we were discussing the fact that if you really want money for a venture capital company at this point in time, you go to China for it, because that's where there's a lot of excess funding, and because Goldman Sachs, Morgan Stanley, J.P. Morgan, et cetera, are not allowed to make investments in these firms. So in theory, you've got a biotech company, new drug, costs $1 billion to get it from the concept stage to the marketplace. Traditionally, you would have a lot of brokerage firms putting money into the creation of that drug for that firm. They can't do it anymore. They're limited to 3% of their capital. So not only has the Volcker Rule taken liquidity out of the market, not only are you 1,000% correct that There's no way to effectively monitor this rule, but also it's impacting the ability of small corporations to bring innovative products to market.
So perhaps some unintended consequences right there, but when you look at this, a lot of people might say, hey, this is reasonable to think that the money that I deposit in my bank account that's insured by the FDIC will be there should a catastrophic financial meltdown happen again. That makes sense, and that's the original intent of Paul Volcker here. But if it's not going to work in the way it's been implemented right now, is there an alternative out there for those folks who say, I believe that my money that I put in the bank that's guaranteed by the FDIC should not be used to speculate in these types of investment structures?
Well, I think, it is possible, if banks were being audited properly, which they were not prior to 2008, to segregate deposit funding and where those deposits are being used from, if you will, the retained earnings of the firm and the wholesale money that they borrow in the open market. So I do think that is possible, and I do think it would assuage a lot of the people who are really upset about using FDIC money, as you say, for speculation in the markets. So I think that can be done, but we've gone way beyond that. We've gone to the point of saying you can't use any money that you've raised in the open markets, whether from depositors or from other investors in proprietary trading. And that, I think, is excessive, and I think that hurts the markets.
Simo Mo said the casual investor, the basic Joe who's sitting on the street, Dick, what does this mean to him and her when it comes down to their investments and their economic future?
Well, I think that's the key point. The key point is if you're taking liquidity out of the marketplace, and that's not going to happen for Microsoft or IBM or maybe even Facebook or Twitter. But if there are thousands of companies and they have stocks in the market. If you don't allow the brokerage firms to have proprietary positions in hundreds of companies, when the average investor says, I want to sell my shares in XYZ, he's going to get less than he would otherwise get if the market was more liquid. When the average investor says, I want to buy, ABC, he's going to pay more than would otherwise be the case. Now, again, that's not going to affect Microsoft. It's not going to affect stocks which have, millions of shares trading on a daily basis. It is going to affect the trading in smaller companies with smaller floats. And I think the bottom line is people will pay more for what they buy, and they will get less for what they sell because of the Volcker Rule.
The little guy. There you go.
Always comes back on the little guy, it seems to be.
Well, Dick Bove, we thank you for your insights about the Volcker Rule and the exceptions that bureaucracy suddenly seemed to put in the way with that. Your comments coming up. You see the social media outlets you can utilize to get in touch with us. America.